Chat Stocks, a podcast where we help you find your next great investment. And today, earnings season is officially kicking off. I'm one of your hosts, Ryan Henderson, and I'm joined, as always, by the one and only Brett Schaefer. This is our weekly Power Hour episode. We talk all things financial markets. And as I assume the title is going to indicate, we're talking about earnings this week. Netflix reported, ASML reported, Interactive Brokers, trying to think of all the other, Taiwan Semiconductor. We've got huge CapEx plans from Meta, and I literally mean physically huge. And then we have a massive crackdown from Cloudflare on AI scraping, which may have some big implications if you're a Google shareholder. We're going to get to all of that in a second. Quick housekeeping items. We do these shows live on Thursdays at 5 o'clock Eastern time, 5 p.m. Eastern time. If you want to tune in, head on over to our YouTube, check out Chit Chat Stocks, and feel free to ask some questions. We also post these on our podcast player, so don't mind if you listen there as well. And if you like the show, please, 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 please give us a review. That's the best way to help us grow. Let's kick things off, Brett. Let's talk earnings. Where do you want to start? You want to go by the chronologically here? Go by the first reporting?
Yeah, what would listeners like to listen to first? ASML. We had a lot of people talk and ask about ASML. I think 3 or 4. So why don't we kick it off there? Stock's looking a little cheaper. I will say, if you want more in-depth analysis, go check out our friend at Best Anchor Stocks. Leandro writes a lot of good stuff over about ASML. Ryan, you made the notes. What happened? Why is the stock down? And then we can get into the valuation.
Yeah, I honestly find, before we get into some of the numbers, I find ASML just kind of a bizarre stock, I guess, because it's very volatile, but the business itself, like it's it's going the growth is fairly predictable in the sense that they will grow. They have this just massive moat, and they're a total choke point in the semiconductor industry. And semiconductor spending overall is growing. Like, if you see that Taiwan Semiconductor is spending tons on CapEx, that bodes well for ASML. So, like, you have good indicators for them, but then you have so much volatility. It just kind of surprises me, I guess. The big thing here, like, if I just go through some of the numbers looked pretty good, like just the headline numbers. Net sales were up. Maybe I don't have the actual figure, but net bookings were 5.5 billion, which bookings is kind of a misleading figure for them because it could be one day later and they could add $400 million in bookings with one new machine sold. So the sales is kind of the figure of the track there. Net sales were $7.7 billion, 7.7 billion euros, excuse me. Uh, Gross margin of 54%, and everything looked pretty good. They said they expect a full year 2025 net sales increase of around 15%. So, kind of business as usual for them. They just continue to be the innovator in the lithography space. But then they had one quote that I guess sent the stock plummeting more than 10%. Let me find it. Okay. It says, looking at 2026, we see that our AI customers' fundamentals remain strong. At the same time, we continue to see increasing uncertainty driven by macroeconomic and geopolitical developments. Therefore, while we still prepare for growth in 2026, we cannot confirm it at this stage. What do you think about that quote?
Eh, they don't know what the government's going to do of the United States. They seem to switch their strategy every month, so they have to say there's some uncertainty there. I think the key for any investor, and I'm looking here while you're talking, I loaded up the chart on fiscal AI trailing EV to EBIT, which I think is a fairly good metric. You might want to toss in some forward ones there and maybe normalize some stuff if you think there's any sort of lumpiness, but that's more of an in-depth discussion on ASML. EV to EBIT 21. Right now, that's near the low on a kind of post-COVID basis, even a little bit pre-COVID as well. If you think that demand is there and you have a longer time horizon than 2026, which I think a lot of investors don't, A lot of investors might be impatient there. This could be a good buying opportunity if you believe that earnings can grow at a double digit rate and you can buy it at 21 times earnings. You have 5 times earnings yield plus a lot of earnings growth. That's not a bad scenario, especially for a company that a lot would consider a rock solid monopoly. So
Yeah,
I'm not
definitely.
I'm not buying. It's a little big for me. I like smaller companies these days. Maybe that's a weird thing to say to artificially put myself on, but I would I think it works from here if you have a 5-year time horizon.
Yeah, I mean, they can only grow so fast. Like, they could take on a bunch of bookings. Well, for one, they only have so many customers that can afford their machines,
And they
but they
only
could
have so
take
much
on
manufacturing capacity.
they only have so much manufacturing capacity. They could take on a bunch of bookings, but that doesn't mean they can deliver it right away because that manufacturing capacity. So, you're like, there is some ceiling, I guess, to their percentage growth rate. The thing that surprises me here is, like, if they didn't say anything, like, if they would have not said a word about 2026, I imagine the stock would be up, but they tried to quell, I guess, any future damage that could be done by saying, like, "Look, we don't." You could have replaced their quote with, "We don't know what's going to happen in 2026," and it would have been functionally the same. Did anyone going into this think that tariffs, what they said, could not have been new to anyone? Obviously, customer demand could change if there's a big change in tariffs. So it
Sure.
just kind of surprises me that the stock is so volatile. Here's the thing that I think matters the most and what people should care about. It's a quote from TSMC's, I guess, quarter ago conference call. I think they re uh, restated these numbers and it was just still the same, but they said, combined with our previously announced plan to build 3 advanced semiconductor manufacturing fabs in Arizona, this brings our total investment in the US to $165 billion to support the strong multi-year demand from our customers. They have like they have plans to build, I think it was 11, more than 10 new fabs between Taiwan, Japan, and the US. I don't know what the dates are on those. That is just m music to the ears of ASML shareholders. Because what do you think those fab facilities are gonna be packed with?
Yeah,
A
it's
ASML
pretty
machines.
good, pretty good growth trajectory for sure. Are you buying, Ryan? Do you own this stock?
I don't own this. The other thing I'll mention is they are buying back a good chunk of stock, so 4.5 they've spent $4.5 billion on buybacks over the last 2 quarters, which I think comes out to about 1.6% of their market cap. So now, cash flow is somewhat lumpy for them, so it probably isn't useful to annualize that, but if they did annualize that figure, you'd be looking at about 3% of their market cap being bought back, being repurchased on a go-forward basis. I I think you can make money here, but yeah, I'm kinda with you. It's a little too big for me, which is funny
But
because 'cause we're about
you
to talk
own way
about
bigger
TSMC.
stocks.
I know.
So what's the I
Maybe
think
not too big. I don't love, I guess I don't understand them perfectly, although I think I get the gist. But I don't love that their growth is somewhat capped by manufacturing capacity. Like
yeah,
Taiwan
they're
Semiconductor,
yeah.
you could make the same case, but they're growing much faster and they can frankly raise, well, I guess ASML could raise prices too, but I don't know. I feel like growth could be higher for TSMC, I guess.
Growth could be capped on ASML for sure. It's almost like a guaranteed, and that's a dangerous word to say in investing, but it's almost like a guaranteed 10 to 15% return. We have a comment here that says 2030 guidance is about 44 billion to 60 billion dollars in revenue. I think that's euros, but converting to dollars, not that big of a difference. It's not that much growth compared to what TSMC is doing, which I guess we can go straight into them, kind of related. They reported this morning $30 billion in revenue versus $21 billion a year ago in the same quarter. So pretty fast growth. I think that's about 50%. 50% operating margin, 60% of revenue coming from 5 nanometer and below. So 5 nanometer and 3 nanometer, 60% of revenue coming from high performance compute, growing 14% quarter on quarter. Market cap of $1 trillion, Ryan. They should do $100 billion in revenue soon. I would think by the end of this decade, $200 billion in revenue and $100 billion in operating income isn't an insane assumption. Are we still underestimating this company? And maybe I'm preaching to the choir here. I'm not an owner of the stock. You're a recent buyer of the stock. What did you think of the quarter? Seems like another fantastic result from one of the best companies in the entire world.
Yeah, it struck me as a pretty good quarter. I think people are underestimating it. Obviously, if something really were to happen to AI demand, which I don't see that happening anytime soon, at least, uh, it could impact their growth rate in a big way. But I just don't see if we think that in 5 years AI spending overall is larger or is higher, I don't see how TSMC doesn't make a boatload of money in the process and get to that $100
Yeah.
billion figure. And even
Are you
if
telling the
like,
next 5 years compared to the next 12 months or from the previous 12 months? Because the next 12 months, we could be getting into, which I'll talk about in another section here, potentially bubbly territory.
so, but yeah, okay, spending could be higher next 12 months than 5 years from now in terms of like they're building out these massive data centers like Meta is. But even in those data centers, they're going to need to upgrade their chips. I assume they want to continue to be on the leading edge. That just can that means more spending for TSMC. So that's what I mean in terms of more spending is more spending on leading edge chips, which is always going to benefit Taiwan Semiconductor. I thought the quarter was good. These quarters can be, I guess, somewhat, I don't want to say boring, but management keeps things pretty close to the vest. Like analysts try to ask questions and they are basically give the
Oh,
same
their
answers
conference
over
calls
and
are
over. It's like,
useless. Don't even
yeah,
don't even read
it's
them.
like we're gonna continue to serve customers and we're expanding capacity. And everyone's like, I know, but like, what exactly is the gross margin going to be in 2 years? It's like,
Well,
who
they don't know.
cares?
They don't know. They don't
And
know. Hopefully as high as possible. Yeah, they're a company I trust very much, but their conference calls are useless. Just read their presentation. There's a couple notes that you just need. What are margins looking like? What was the revenue number? Where is it getting divided into what segments? High performance compute, smartphones, and what have you. Besides that, I don't think you need to do much.
I think you can safely assume about half their revenue goes to operating income. So if you're right on the revenue trajectory,
Mm,
you're
I
probably,
let's look at the historicals. I think it's been lower before.
I think they're at about 48% operating margins, if I'm not mistaken.
Right
Um,
now, I'm
correct.
saying,
It could come down slightly with the US fabs, which is what they're forecasting, but even the bridge between gross margins and operating margins over time, I imagine should continue to contract, which they have. The Here's my thing. They basically laid out in the conference call, they're like analysts kept asking, well, if margins contract, are you gonna like, do anything for pricing? And they were just like, they basically said, yes, if we want to extract more value, we will. Like, if they will get to a margin target if they want to on price
yeah, they do have
because
pricing
they have
power.
that power.
Yeah, yeah. It's really interesting to look at the semiconductor space because ASML and the equipment providers have pricing power. TSMC has pricing power. Some of these other companies that are manufacturers also have pricing power. Nvidia and Apple, I guess, and all these other customers of TSMC seem to have pricing power. It's because it's such a lucrative industry, such an important industry, so large, and there's so few players that seem to have many monopolies at each step in the chain that everyone wins. And if we're looking at the operating margin chart, It has trended upward over time. I conservatively, I'd maybe think 45% makes more sense, but that's still really, really strong. Better than Apple, better than other manufacturers out there. And it continues to be high, and they have that pricing power because for advanced chips, they keep extending their lead versus Samsung, Intel, and I don't know the Chinese players that well, but they're ahead of them.
Yeah, and we're going to talk about the Nvidia news too. I think if they're selling into China, that means more demand for Taiwan Semiconductor.
More demand for everyone. Yeah, I think. What do you think? Did Jensen go to the White House and say, "Hey, if you put out this headline, the stock market's gonna go up"? That's all he
That's
needed to say.
might be all it takes. Uh, let's jump to that. But before we do, we want to talk about the TSOH Investment Research Service, new sponsor for us. I'll just go ahead and say I absolutely love this service. We read it regularly. It's run by a friend of ours, Alex Morris. Inside his research service, subscribers get access to 6 high quality stock research reports per month, including initiation reports, as well as regular updates on current TSOH holdings and watchlist stocks. Plus, there's 100% portfolio transparency. His coverage, on top of him being a phenomenal analyst, and I think making things very digestible for all the readers, he covers interesting companies, which or at least interesting to me. Companies like Airbnb, Celsius, Roblox, Netflix. I know most people won't think this one's exciting, but Ally Financial, he helps me with that. Uh, TSOH is a premium research service. And if you're serious about investing, this is like outsourcing a professional analyst. I lean on him for quarterly coverage of a couple of the companies I own. He does get, like I said, full portfolio transparency, and he talks about his returns, and he's absolutely crushed it over the last 2 years. If that intrigues anyone, but if you're interested in the service, head on over to thescienceofhitting.com. The link will be in the description. Again, that is thescienceofhitting.com. Do you want to talk Netflix earnings?
Sure, sure. Let's talk Netflix. I haven't looked. What were the numbers?
This may have I know this is not a good tease for anyone listening to the podcast, but this might have become one of the most boring reporting companies out there. It seems like very predictable business at this point, and they have such good control over their margins now in terms of they can really turn up pricing, they can turn on the ads. And it just seems like just a really well run business. 16% revenue growth, slightly above their guidance. 34% operating margins versus 27% a year ago, also ahead of their forecast. Now, in this case, the primary driver of their outperformance relative to guidance was a weaker than expected FX headwind, but they grew members, they increased subscription prices, and they increased ad revenue. And I would say they did this all with a pretty weak content slate. And now that's
That's your
partly my
personal
opinion,
opinion.
but
Not a
also,
Love Island fan, Ryan? Huh?
well,
Isn't
okay,
that what
so
people are watching? Isn't that their number one show?
I don't know. I'm not sure, but they do give that data out, so maybe I could check. The it's I think it was kind of a poor slate, but they also said they produced all these solid results, record engagement, record members, and successful price increases when the majority of their content slate is weighted to the second half of this year. So hopefully, I imagine for them, should be even better results coming out of the second half of the year. I thought this was an interesting stat, and it kind of it goes to show just how valuable Netflix is and how they're not dependent on any one thing. So it says, we are not dependent on any one title to drive engagement. For instance, even our biggest titles that have tens of millions of views account for less than 1% of total viewing. They really are. You think about like HBO, maybe even Prime Video to some degree, Apple TV, those services, they might produce great content, but they're typically driven by a couple of franchises. and viewership, I would guess, is somewhat cyclical and tied to those franchises. Netflix is just not the case. They are growing with their top titles accounting for 1% of the viewership. They're still growing members into the biggest service in the world, biggest streaming service. So it's an exceptional business. There was one quote that stood out to me that I want to find that basically encapsulates their entire business model at this point. Let me find it real quick. As we deliver more value to members, we continue to refine our plans and pricing to improve monetization, which in turn allows us to reinvest to make Netflix even better for our members. They're at the point where they have this competitive advantage. They've got a wide enough content slate. They can start to take profitable gambles, I guess you could say, on different types of content like live events and even gaming. Um, Not sure if gaming's a profitable gamble, but I imagine those live events are given the engagement they get. And they can just reinvest in the platform at a much higher rate than pretty much all the other streaming services. So last year we said Netflix won the subscription wars or the streaming wars. I see no evidence to disprove that theory. I think the streaming wars are over.
I agree for the most part. The only thing that would be a leading indicator of a long-term concern over the next, and this is not going to happen next year, but over a decade, is the fact that watch hours on TV, YouTube is growing market share much faster than Netflix. Now, both of them are taking share from traditional players, and there's still about half of viewing hours that on regular cable or legacy broadcast stuff that is going to go away. That I would say that is a bit of a concern. I got nothing to say on Netflix. Good company. EV to EBIT. Do you want to guess what it is right now? I'm looking it up right now on Fiscal AI.
Trailing EBIT?
Trailing EV to EBIT. Maybe it hasn't updated this quarter yet, but shouldn't be too much of a difference.
Gonna go 50 times.
Pretty close. 48.6. Not a buyer here. Gosh, just
No.
I guess people are scared and running to quality, but at a price of $1,200, man, that's it's just not appetizing.
No. I've got the revenue per region pulled up here as well. And a beautiful chart. Shout out Fiscal AI. And if you're interested, check out our link fiscal.ai/chitchat. Gets 15% off. Growth in all regions this quarter, 15% in North America, 18% in Europe, 9% in Latin America, 24% in Asia Pacific. They have content for every region. I just don't see how someone like I could see how it slows down, although they've got a lot of monetization levers they can pull now with advertising. But I don't see how anyone ends up supplanting them as the leader in streaming.
YouTube for sure. I mean, YouTube is the leader in streaming.
Sorry, the leader in
You have to
original
pay a
content
subscription.
paid streaming.
It's all overlapping. You can pay a subscription to watch YouTube without ads. I think that is their number one competitor. Video games is a competitor. Staring at your phone is a competitor. The competitors that Amazon, maybe with sports, but Apple TV, HBO, I'm forgetting the other ones. Paramount. It's a joke. It doesn't matter. Netflix has beat them. Their competitors are well, who I just mentioned. Video games, YouTube, essentially people's leisurely hours staring at a screen. Can they win more hours of that? Probably. In the US, I think it's going to prove more competitive than people think over the next 5 to 10 years. There's only so many people and so many hours that you can spend watching TV. Although maybe I'm underestimating the laziness of people.
Yeah, I think you underestimate how many people are willing to pay for a service like this, have it on in the background, and play on their phone at the same time. Okay. Do we,
I was
people
gonna
have said
say,
it's a
can't
growing
imagine
trend.
doing that, but yeah, you are correct. That is what a lot of people do.
Before we jump to we've got a lot of AI topics, I guess. You could
As always.
encapsulate it as AI.
The news keeps coming every week.
Let's maybe do something fun. Do you wanna hit either a quick bubble watch, or maybe we could talk about, Mr. Jerome Powell
Ooh,
on the hot seat,
he
as
could be on the
always.
hot seat. The bond market's gonna save him. Someone asked what we use for streaming services. I made a rule for myself. I'm only watching sports now. Honestly, I got not wasting my life anymore, but that's just to answer that question there. Let's do bubble watch. There is a new acronym, Ryan. I'm sure you saw it because Jim Cramer, the man, you may love him or hate him, he's got style, right? He knows how to put on a show. Jim Cramer, famous CNBC host, said a new acronym for the meme stocks that just won't quit. Three exclamation points. PARK. Palantir, App11, Robinhood, Coinbase. Some people reversed it and said that these could be crap stocks. He may have done that on purpose because he knows how to drive memes. I think. I think he knows what he's doing. He's an entertainer. Let me give you some numbers on what these stocks have done since the beginning of 2023, which is just a tad over 2.5 years. Palantir or Coinbase, cumulative return, and this is the worst performer. Cumulative return of 1,000%. Palantir, 2,250%. App11, 3,270%. Robinhood, 1,170%. If you bought at the beginning of 2023 with any decent amount of money, you are very rich. But I think you have to make a really tough choice now because are these insanely overvalued? I haven't looked deeply at most of them. Palantir, I'd say yes. Honestly, full disclosure, I put on a tiny short on Palantir.
Really?
Yeah.
Is that your first
Uh,
short?
yeah, barely small percentage of the portfolio, but just I don't want if we're talking publicly about something, I should disclose stuff like that. Nothing against the people that made 2,000% on the stock. I just think it's one of the most overvalued in history. Its price to sales above 120 maybe at this point. It's a market cap of $350 billion, and it's I don't think ever going to grow into its valuation.
Let's take a second here. Do you think this is the most overvalued stock in history?
I think given the market cap, yes. Now people are giving examples back of the dot-com bubble. Yahoo, as an example. They were smaller market caps. Yeah, the price to sales ratio might have been just as insane, but I think if you include the actual size and maybe we're not adjusting for inflation, but I think it takes the cake. You have something like Tesla in 2021 that could be an argument, but their financials were much larger, even though I would say that they've proven to be fairly overvalued from that level. I don't think it's as insane as Palantir.
Yeah, trying to just for fun, trying to do the math on what
Oh,
it would
what could get
take,
it to a reasonable valuation?
yeah,
Yeah, try
it
that.
would require outrageous growth, and I can already hear some people that maybe own shares like, "Well, they can grow at an outrageous pace," but to do it for they'll need to do it for 15 years at Amazon level growth rates, which frankly, they don't have the addressable market to do it at. Uh, so I it's absurd. I honestly, I agree with you. I think it's one of the most overvalued in history. And if you go down the list of, I know this is like a flawed way of thinking, anyways, but if you go down the list of companies that it's larger than, it blows my mind.
Yeah, it's like 25th largest company by market cap in the entire world.
Larger than Bank of America.
Yeah,
And
yeah.
Bank of America does, I think, $27 billion in net income. I'm pretty sure Palantir does like, maybe I'll
3
put
billion
some
in
numbers on
revenue.
it. Really?
Yeah, 3 billion in revenue.
Let me
All
pull
right.
up a chart. I'm gonna pull up a chart. Keep talking.
Well,
Let me put some,
so
I'm gonna put some numbers on this.
when I mentioned that investors have to, if you own these, you have to get put into a tough spot because I just think Okay, let's say you have a huge winner in one of these. I would applaud you for that, but I don't know if all 4 of these are grossly overvalued right now. Maybe one is still reasonable, something like that. But if they are grossly overvalued and you think, this could be dead money for 15 years, you have to make a tough choice. You either keep it and maybe forward returns are terrible, or you sell and take a huge tax hit. I just don't like these type of stocks. My question is, Ryan, if and I know you wouldn't, neither of us are doing this, forced to go long or short this basket, equal weighted, not your entire portfolio, what would you do?
Short. Yeah. Come on.
It's dangerous though. You can't this is why if you short
Well,
stuff,
I
you
know it's
should not
dangerous,
make
but
them
you
large
have to do one or
positions.
the other.
Yeah,
It,
exactly, exactly. I agree with you. Yeah.
it well, maybe you could go long. Maybe one of these works. And here's the thing that I find interesting is like the companies that always get the most insane valuations are the ones that have legitimacy to their business model. It's not the ones that are like, well, and maybe you can make the case for Nikola or whatever in
Nikola,
2020.
yeah,
And there are
classic.
some concept companies that get to extreme valuations, but
Rigetti, quantum computing. Yeah.
but when you have legitimacy behind your business model as well, then I think it can get to crazy, crazy numbers like Shopify. I'm pretty sure Shopify has put up incredible numbers over the last 4 or 5 years.
Talking
I
about
still
revenue,
don't thi
financials.
I still don't think they've hit their all-time highs from 2020.
No, stock is at I think they did a split. Stock is at 127, give or take, and it peaked at 167 in November of 2021. At that point, the market cap was $200 billion. I think they were my old pick for most grossly overvalued stock, maybe Snowflake as well, because their price to sales ratio was at 60. But Palantir's is double that, Ryan. Double.
Okay, so I got some numbers on it. Bank of America over the last 12 months, actually $28 billion in net income.
Look at that chart.
Palantir, which it's not like, oh, they don't have any earnings. They are a profitable business, like, and they've shown some operating leverage. 571 million in net income over the last 12 months. They are doing some back of the napkin math here. Bank of America earns 54 times more money on an annual basis than Palantir, and Palantir's bigger. It makes no sense to me. And
Well, okay,
that's a
here
big
here
gap to make up.
I have a question for you. Over the next 20 years, will Palantir earn cumulatively either free cash flow minus SBC or the net income that Bank of America has earned over the last 12 months of 1 year?
Over how many years for
The
Palantir?
next 15, 20, I the fact
Maybe.
you have to think about it
Th
the fact
they
you have to
might
think
they
about
might
it
be able to get there.
yeah, the fact that you have to think about this. We are not at the Mag 7 level, I don't think, but we are at 2021 vibes across the board on all these shitcos. Across the board. This is time to stay conservative. Wait for the fat pitch. The fat pitches are not here. I just it's getting dangerous out there. That's all I'll say.
I honestly don't know anyone that is actually buying Palantir at these prices, and so maybe that's just my circle of people,
Someone
but
is someone's got to do
obviously
it.
some people are, but I don't even some of the most bullish people I know have gotten to the point where like, "I love Palantir, but I think the valuation's a little stretched," and they're like
Oh,
the
yeah,
most optimistic.
hot take, a little stretch. What a wow, really going out on a limb there. My god. Prices will drive people to conclusions that they never thought they would make. The most irrational conclusions. Price drives your narrative. You have to remember that. That's your instinct. And this is what the same thing has happened in 2021. Learn your lesson. That's all I'm saying to the listeners.
Okay, before we move on, And before we talk about potentially Interactive Brokers earnings, let's talk about our sponsor, Interactive Brokers. Are you tired of moving money between your bank account and your brokerage account? Well, with Interactive Brokers, there's no longer a need to have a separate high yield cash account. Interactive Brokers offers up to 3.83% interest on instantly available cash. That means if you've got some cash sitting in your brokerage account and you're waiting to deploy that money until you find your next great investment, maybe a stock talked about here on this podcast, now it's actually going to be earning something in the meantime. This is just one of the hidden advantages that comes with being an IBKR customer. They simply do not cut corners, and I constantly find myself surprised by just how much they're willing to do for customers that other brokerage platforms are not. If you're interested in checking them out for yourself, head on over to ibkr.com. Restrictions apply. Interactive Brokers is a member of SIPC. Now, shall we talk about
Do you want to?
Interactive Brokers earnings?
We can, yeah. I always feel weird that they're an advertiser and they've been a good investment for me. I would say go back and look at my research report. I did a full hour-long podcast if you want the full details. And just as a disclosure, it always feels weird that they're a sponsor, but I own the stock. I want to hold it for the long term, and they seem to be
To,
doing well so far. Stocks
and
up about 4 to 5% after hours. Ryan, you got something before I go?
just to be clear, those are two very separate things. Brett owning
Yeah.
the stock and us talking about it has nothing to do with the sponsorship.
Yeah, exactly. So let's go through the numbers. Commission revenue was up 27%, interest income up 9%. So I guess they're getting a little slowdown on that. Interest rates have come down a tiny bit from last year. Pre-tax margin expanded from, and I didn't even think they could get more margin expansion, from 72% to 75%. Could we see 80%? These numbers are insane. This company is so efficient. Customer accounts are up 32%. Daily active revenue trades, which I think that's what DARTs are for their acronym, increased 49%. All I have to say is incredible business. Not surprised the stock is up. And I think looking back 10 years from now, when I bought at during the April panic, and I think it was about the 40 range, I think it's going to end up feels like it's gonna be one of my best investments over the next 10 years. Dangerous words, but this is a company I just really have high conviction in that they're gonna keep growing. People love the platform. It's better than everything else. There's gonna be slow switching because there's friction to switch to a new brokerage, but they're gaining a lot of momentum, and I think word of mouth is going to spread across the board for them.
Well, you mentioned slow switching. Some of these numbers might disagree with you here. Total accounts, shout out to Fiscal AI for tracking this data, has gone from 690,000 total accounts in 2019 to just under 4 million today. So it's 5x its total accounts. Now, I will say the
Lot of room to
average,
run. Lot of room.
this has been, I believe, due to the very successful rollout of their IBKR Lite. Because if we look at, maybe I can pull up some custom metrics here on Fiscal, average equity per customer.
Is it down?
Yeah, relative to, well, maybe this is just the bubble period, but it's shaved off a little bit. Probably down 30%. Yeah, basically 30% since 2019. So my guess is they've made a plan, or they've built a plan that's accessible to people that don't have that aren't massive accounts, and they've now average individuals can unlock the benefits, and honestly they're best in class trading execution. So that's probably been part of the reason for the average equity per customer going down. Now, do you want to see a sign of the times, Brett? Maybe this will
Okay.
help you with your bubble watch. I'm going through a whole bunch of data on Fiscal AI here. Total customer equity,
Yeah.
which is just, I mean, it's
That's
predicated
but it could
primarily
also
on
be a
market
lot of
valuations.
deposits. It's.
It could be hit.
Ooh, that's a nice bump.
Yeah, this
Yeah.
quarter was real good. And now they did grow active accounts, but my guess is the majority of that has to do with uh, market valuations.
Yeah. We have a comment here. IBK is the best brokerage platform, hands down. Thank you for agreeing. I think our sponsorship they like those comments from the listeners. When you say 3.8 million, Ryan, remember Robinhood has 25 million accounts. I know there can be overlap with people. Robinhood has 25 million. I think Schwab has 30 to 40 million. Vanguard has like 50 million. And this is just in the United States. Globally, I think IBKR can easily get to 10 million and just keep slowly gaining accounts over the next decade and beyond. It's not like, "Oh, you can just download this platform and try it." It takes a long time or there's a lot of friction to switch, like, "Hey, I need to get my accounts transferred over." It's a multi-step process, but it's a great business, and those margins, they'll make you salivate. It's basically, there's that Visa hurdle. If margins are above Visa, it's a damn good business.
What are the highest post-tax margins possible? Because the
For them,
income tax is like what, 20%, slightly lower, 15? Like,
sure, let's just assume that. So I think they could get the pre-tax of 80%, so 65% to 70% post-tax margin seems doable. Why couldn't they get to 80%?
is that the highest margins you've ever seen?
I think so. Maybe Evolution Gaming, maybe some weird software companies, but outside of something that's a strange situation, that's almost like a licensing deal. Yeah, these are dang this it's a good business. It's a good business.
Yeah, it is.
I'll say it a
Okay.
million times.
Before we go talk about Meta's outrageous spending, I want to talk about this crackdown on the AI platforms. Did you hear about this?
I did not. Yeah, maybe since I'm sure it was spread around your internal communications, you're more in the know, keeping up on the day-to-day stuff since you work literally at an AI startup.
Yeah, so Cloudflare, which is, I believe, one of the most popular content delivery networks in the world today, 16% of the world's internet traffic goes through Cloudflare. And if you want to remember just how impactful they can be, think back to their outage when they launched one product that had like some flaw in it. They launched some update and it basically took down the global internet. Um, so apparently Cloudflare is going to start blocking artificial intelligence crawlers from accessing content without website owners' permission or compensation by default. Here's a quote from Ben Thompson, who is always exceptional at dissecting this kind of news. He says, Cloudflare launched an easy to block AI crawler a year ago, and they say that more than 1 million customers have enabled this feature since then. That, however, was an affirmative choice. Now, tens of millions of websites will block AI crawlers with immediate effect unless they affirmatively agree to be crawled. And then he has a section about Google's advantage. He says there is one important exception to these defaults Google, which has two crawlers. Google Bot crawls the web for Google search, while Google Extended crawls the web to capture data for Gemini. What is critical to understand, however, is that data for Google Search AI products, including AI overviews and AI mode, is gathered by Google Bot. That means if you want your website to show up in Google search, you have no choice but to have that data also be used by any AI product that are under their search umbrella. This feels like a kind of a flex of power on Cloudflare's part, but this feels really damaging to the, I guess, answers out of a lot of the foundational models, uh, pretty much everything except Google. Am I thinking about this wrong? Is this not a massive win for Google?
I would think so. Looking at the outside, not sure how this tech really works besides the basics that people outline. Seems like Google will do well. If it's 16% of the internet traffic, though, maybe that in a vacuum is not the biggest loss. But from what I understand, the most important thing is conversational stuff such as Gmail, you have Reddit, Twitter, YouTube, I guess, for video and conversations. They'll probably train on this data that we're giving them right now. I've found that you can with so I've written like 2,000 articles for the Motley Fool or something like that. They've probably trained on a lot of that data, and they can put something out that's kind of gibberish, that doesn't actually make sense, but it's in the exact style of how I write for the Motley Fool and how they want people to write. if that stuff goes away, yeah, I think this could be a concern. You're in all this art. You could start having to use what is it called? The fake data, the artificial data that is just created. It seems very strange for me. But over the long term, the companies with the data seem to have a more rock solid foundation. OpenAI, Anthropic, and some of these other companies have gone wild west, I would say, to try to capture all this data and train, and that could be reversing going forward. I've seen a lot of lawsuits out there. Don't know how they're going to work out, but Alphabet, as usual, has a clear competitive advantage in essentially everything in AI. The only question is if they can execute with branding, product strategy, getting distribution to customers.
Yeah, I agree. I've always been sort of unclear on the legality of like ChatGPT's business, I guess, in that
Crawling every website, training on other people's data.
scraping other people's data and using it has always been a confusing concept to me. It's always felt like maybe it was wrong, but everyone was doing it, so it was like, was it acceptable? So I imagine this is pretty impactful, this from Cloudflare, and might impact the answers or the quality of the answers that you get from a lot of the conversational models. We'll see. I'm a
I'm
Google
a Gemini
shareholder,
guy,
so maybe
so
I
I'm gonna
isn't
I'll
that
be
isn't that
fine.
like a
It
astrological sign?
Yeah, exactly. That's why I think it's funny to say that.
Uh,
Yeah,
yeah, as a Google shareholder, I think this has got to be viewed as a positive.
I think so as well. Okay. Meta's data center plans, Ryan. You want to learn about depreciation expense?
Let's do it.
Did you see this chart I put in? Meta and I guess Zuckerberg, so Zuckerberg's the one leading the charge here. He has been, and I think it's maybe to get people onto the Twitter competitor threads, which I don't really like too much. Uh, Maybe because you need an Instagram account. That's besides the point. But he was on threads putting a thread together about their new data center plans for their super intelligence teams. We talked about last week, and I think 2 weeks in a row now, about how they've been trying to acquire all the best scientists with huge salaries. And in order to acquire them and entice them, he wants to build the best in class infrastructure out there. Again, I would say this is trying to catch up with Alphabet, who's been doing this for 15 years. So here's the quote: for our super intelligence effort, I'm focused on building the most elite and talent dense team in the industry. We're also going to invest hundreds of billions of dollars into compute to build super intelligence. We have the capital from our business to do this. Two things I think should make investors nervous. One, hundreds of billions of dollars, not 100, hundreds. And saying, second, we have the capital to do this. Not saying it's going to have a positive ROI, but we have the money, so let's burn it. Apparently, Meta is the first company on track to produce a 1 gigawatt cluster. I forget all the exact terminology, but essentially, gigawatt is a lot of electricity and a lot of electric power. Usually, you're in, I think, some of these like 100 megawatts. So there's just the scaling up here is tremendous. Zuckerberg says further on in the thread, they are going to be spending hundreds of billions on multi gigawatt clusters. So I think that means one data center that he says is going to be the size of Manhattan that will have multiple gigawatts of power in that single data center, which would be tenfold increase from like current levels of these giant data centers. My first question, Ryan: crazy, stupid, smart, or all three? I honestly think could be all three.
Yeah, I mean, this isn't the first time that he's I don't want to say staked his reputation, but more committed to spending billions of dollars on questionable projects. I believe, I think it was must have been 3 years ago when he changed the name of the company to Meta. He said, "I think this work is going to be of historic importance," and he basically said he's willing to lose a lot of money on it. He has shown an ability to like still grow shareholder value in the process. So I will give him, I guess, kudos to that. What I don't love, and we're seeing it with all big tech companies now, is the bragging about capex specifically. Like it's a it's a CapEx brag fest. Everyone's like,
Yep.
who can build the biggest data center? Like, I would rather him talk about the returns that this could drive, the impact this could have on the consumer experience, the impact that it could have on the business overall,
I'm just curious that
and
what their
not
business model is with this.
if they're
Right?
plowing all this money into llama, I would be very skeptical.
Yeah, I agree. Okay,
Although,
let's look at the numbers. CapEx for reference, $44 billion over the last 12 months. I think he's saying they're going to go well over $100 billion a year eventually once they can get there. Currently, and depreciation expense, this might not include all of depreciation and amortization, but I think it was the majority using a fiscal AI chart here that I'm sharing for the video watchers. It has grown at a 32% rate since 2015, going from $1.2 billion a year to about $16 billion a year. For reference, and let me stop sharing the screen here. For reference, Meta's revenue is $170 billion. If he does this and they start spending hundreds of billions and depreciation grows to, maybe this is a bit high, but 50 billion a year, will there be enough new revenue to get a positive ROI on that spend? Because it's going to impact the income statement and you need an increase in revenue in order to make up for this gargantuan levels of new depreciation that are going to roll through. Are they gonna get a positive ROI? I understand the OpenAI, Anthropic, or Google argument because they have business models, but Meta's is advertising, sure, but that's a different ballgame. How are they gonna make money? By just making it free on WhatsApp and Instagram.
yeah, I'm not sure. If it's using AI, I'm not really sure what's going on here, but somewhere in the back end to improve ad efficiency and ad targeting, then maybe
Sure, yeah.
there's a clear revenue bump there. But I can't imagine they're bragging about building this 1 gigawatt cluster, the data center the size of Manhattan, specifically just for those back end AI improvements. It's got
Yeah.
to be big spending for Llama. The consensus analyst estimates. So you talked about how CapEx has exploded over the last decade from 3 billion to 44 billion. This year, they're expected to do 67 billion. That's analyst estimates. I wouldn't be surprised if that ends up being conservative.
If they can get to the capacity, yes. I think from reading his thread, we're looking at 100 billion in 2026.
Wow. That's insane. The most capital light business of this size, you think about the business 7, maybe even 5 years ago. They were doing 100, what was it? Let's go back to their 2020 financial statements, shall we? Okay. 2021, $118 billion in revenue, less than $20 billion in CapEx. Today or this year, CapEx as a percentage of revenue is probably going to go from about 15% to, I would guess, 30 to 40% this year. They've become like the capital intensity of Amazon, despite having one of the most capital light core businesses of all time.
Yeah, and the multiple keeps rising. I'm not a buyer here.
Anyway, all
Good
right.
business. But
Yeah, of course it certainly was and is. Its core business is incredible, but
I can't understand people when I say that these businesses models are getting worse, like if the business was rock solid, these Meta was is one of the best businesses ever. Instagram's one of the best businesses ever. Facebook's still one of the best businesses ever. WhatsApp is developing into a good business with a strong network effect, but they were capital light. If you have the same exact business, but it's capital intensive, it's a worse business. It just is.
yeah, I think the argument most people would make is that they can turn this off if they choose to. But CapEx seems like an addiction to some of these management teams.
Yeah, it's a good way to put it.
All right. Do we wanna talk about Musk's, circular investment, shall we call it?
Yeah. Yeah, sure. These should be quick. We can hopefully hit Musk and Jerome Powell, maybe Rocket Lab since people are asking about it. Musk, I'd say I'm a very strong Musk follower. I know, I've known him well after reading too much into him for the last 10 years. And I think the most important recent development people need to track is these cross investments and proposed cross investments that he's dropping into the Twitter sphere and trying to make happen by just saying things. You, the listener, can make your own conclusions on why he's doing this. But this week, SpaceX made a $2 billion investment into XAI. Were the huge VC backers of SpaceX okay with this? Did they think? I thought they were investing in a rocket company, but now we're going to invest into a talk about capex intensive AI startup that is well behind scale wise. XAI and the company, sorry, he loves the name X, and Twitter, essentially Twitter and this XAI startup merged for $113 billion in combined value. Elon wants Tesla to invest in XAI. I predict that what the man really wants is to merge everything into one company.
Yeah,
This, to
probably.
me, it's reminiscent of the 2016 Solar City debacle where liquidity was tough. Things were spiraling for his empire of companies, and he took on a really, really bad acquisition to save his cousin. This very, very much reminds me of this.
Have you so this might not be XAI's core business, but I tried to use I don't know if Grok and XAI are the same. I assume Grok is like the conversational model on top of XAI. The I tried to use it and like asked it a question about a if there was any standout quotes from a company's earnings call, and it fed me an answer from my own tweet, and I just realized
Good.
that they're pulling from probably one of the most unreliable data sources
Sarcastic data
out there.
sources. Yeah.
Yeah, like, think about all the crap you see on Twitter and unsupported, opinions for the most part. It feels like it's gonna be hard to parse, what's truth from what's not and what's sarcasm from what's not, and it just feels like a pretty we talked about data as an advantage. I would say this might be a disadvantage to be using that data.
Maybe. Maybe. And people talk about Grok. They can talk about it all they want. I know what I'm using. I know what people use. ChatGPT and Gemini and Google. Google/Gemini. People can at Grok in replies and get a stupid response. That's not a business model. Um, yeah, I pulled up Tesla's stock price. It's at almost exactly $1 trillion market cap. Would you think it's reasonable to take 10% of that stock and do an all stock deal for X and XAI
Here's my
and then
question to
raise
you.
they'll probably need to raise honestly like $50 billion, but
I'll take your question and I'll raise you one. Which business would you rather own?
Tesla or X and XAI?
Yeah,
Oh man, neither.
but you gotta own
At
one.
at $113 billion valuation, what's gonna lose less money? I think Tesla.
You think you'd rather own Tesla there?
Yeah, X and XAI are probably burning an insane amount of money, have no path to profitability, and are wildly overvalued at $113 billion combined market cap. Now, Tesla's wildly overvalued, but I think there is some semblance of normalization of the EV business that could get established.
Sure.
But I think X and XAI could go to zero fairly easily.
Okay. Jerome Powell apparently potentially fired. I didn't even know this was possible.
Yeah, a letter was drafted, Ryan. We're gonna spend another hour going through line by line the Federal Reserve renovation plans and doing an investigation to make sure they were not misappropriated. No, that's gonna be next week. But as a reminder, when we discuss anything political, we're looking at it through an investing lens. We don't care what side any of you are on. We're on none of your sides. Quote, Trump confirmed that in a White House meeting Tuesday night with about a dozen House Republicans, he had discussed the concept of dismissing Jerome Powell, long a target because of his refusal to lower interest rates as Trump wants. Apparently, most of them said he should, but I mean, these are House Representatives people. Bond yields ripped higher on the rumor, so people are nervous. It's the exact opposite of what they'd want. But then then they fell back to, or whatever, rose back when the idea was shot down and that, oh, we're not actually going to do it. They kind of tossed that out into the news cycle. Trump then said he was told the markets wouldn't react well if he fired him, so he has held off. And the big bank CEOs, such as JP Morgan Chase's and Goldman Sachs, have said publicly that it shouldn't happen. Many people have started to say this. It seems like the market and the bond market are going to keep this in check, as well as the Federal Reserve presidents that are members that are in the president's ear. But if Powell gets fired, will that change your investment approach at all? Because I'm telling you, it makes me nervous. I think Fed independence is very important,
Yeah,
but I'm not
I
sure I
agree.
can do anything about it.
Yeah, I don't know if it would really change my investment approach, but yeah, it would make me very nervous and kind of cynical a bit, honestly. It would turn me into a bit of a cynic. It's This is honestly why I love the market, because it's the ultimate feedback mechanism. Anytime Trump has a dumb idea and he puts it out there, the market tells him how dumb it is.
Yeah.
And it's I mean, you see that in this case, it happens right away. Like, the feedback is obvious because bond yields rip. With equities, sometimes takes a little longer for the truth to come out, but it is like the ultimate weighing machine, as Munger says. So it's nice that in this way, it's actually nice that he kind of used it as his scorecard a bit. I've always thought Trump cares a lot about what happens to the market. Most presidents do, I guess. Um, and I doubt he really wants bond yields to rip higher. So I imagine he'll hold off.
It's interesting though, because if I think the Fed is worried about what tariffs are going to do to inflation, that came out this week, and if we look, it has accelerated in recent quarters or recent months. April was 2.3%, May 2.4%, June 2.7%. So we're getting off of that 2% target. What do you expect the Federal Reserve to do, especially when a lot of the macro stuff looks solid right now? Doesn't matter that homes aren't affordable. That seems to be what they care about. They're calling for interest rates to be, I think, at 3 percentage points lower for the Fed, which would be, I think, 1.5%. I would be very worried about inflation if that happened.
Yeah, that seems unrealistic. I honestly feel for Powell. I know we're running up on time here, but like, I can't imagine that. What a horrible job to have, and have him like putting all this political pressure on you.
He's a good patriot. He's serving the country. That's all I'll say. Seems like he's made some mistakes, as anyone does, but
Yeah.
he's
All
doing I
right.
think he's trying to do his best.
I think that's going to do it. Thank you, everyone, for tuning in. Thank you to our sponsors, the TSOH Investment Research Service, Interactive Brokers, and Fiscal.ai, which is an awesome tool to have during earnings season. Thank you, everyone, for tuning in. We want to remind you that Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Stocks is not formal advice or recommendation. We may buy, sell, or hold any of the securities discussed in this podcast. So do your own work. Thank you again. We'll see you next time.